So this is a channel. You can see it right here. 474.89 to 477. There's your first channel. Everybody see it? That's a channel. See how big this channel is? That's a channel.
That's a nice one.
Yep. You can also see the channel right here and right here off of yesterday's post market. That is this spot to this spot. This is a channel. Calls on support, puts on resistance. Call, put, call, put. You see it, everyone? Yep. Then it will eventually break through the channel. Then we look at the next channel. There it is. You can now see that it was channeled off of this level and this level. This is now your new channel. Same drill. Call, put, call, put, call, put. Eventually breaks through, stops out, go long. Now you're in the next channel. Does you following me?
Mm-hmm. Yeah.
That's it. This is scalping 101. As soon as I'm starting to think that way, right, I'm not looking at the percentage of my options anymore. I'm looking at where the share price is, right? So I don't need some sort of imaginary at 18.6% I'm going to get out. I go, no, if it drops below here to here, this is my out. Doesn't matter the percentage at that point, because you're never going to be able to figure out exactly what that percentage should be. That's why I kind of give you guys generic terms that contracts, a good rule of thumb is 50%, right? That's a great base to start with. If you paid $1 and it goes up to $2, $1.50 is a great stop, right? You're guaranteeing locking in 50%. If it continues to move up, it's up to you. You can, make it 70%. So you can have a 30% buffer the whole time it goes up. You paid $1, it's at $2, you're at 50. You're at $1, and it goes up to $2.50. Well, instead of now being 50%, maybe you scoot it up tighter, right? Just to make sure you collect a little bit more. Or the farther it goes away from what you paid, what I like to do is actually loosen it up more, because I don't want to get stopped out. I already know I'm going to make 50% on this. So why not give it a bigger amount of room, right? Because the idea is, everybody, you will make more money allowing it to run forever than those little pennies getting stopped out. Okay? Because again, this comes back to position size. If you have the right position size, you won't be worried about the minimal amounts getting you stopped out. If you're in too heavy and you're looking at your stops 24/7, you're in way too big, right? Think about this. Put this in your heads, everybody. If you are in a $10 trade and it goes back $5, I bet none of you would panic. That's 50%. How much you want to bet you guys would let that thing run till the cows come home and make $30, 300% on that trade because you never feared losing $5? Am I right?